Okay, so here goes my attempt to try to take away as much fluff as possible and is in the shortest amount of time possible give you what I think are the most important things to understand about volume profiling, auction market theory, market profiling. What I call the trading framework is the product of that. So firstly, auction market theory, very simply, without reading any books and spending hours and hours or months and even years at times to figure this out, okay? Auction market theory, the market is an auction. So the auction theory basically says the market advertises price until there are no more buyers or no more sellers. So if it's moving higher and the buyers are not willing to buy any higher prices, the market then stops moving higher. If the market is moving lower and the sellers are not willing to keep selling at lower prices, the market stops moving lower. And of course that happens many times throughout the day. It happens intraday on a very micro level, but it also happens on a more slower pace level over the longer term, and you'll see exactly the same things happening again and again and again. It doesn't matter whether you look at daily, weekly charts, 5 minutes, 15 minutes, 10 minutes, tick charts, volume charts, you name it. You know, people get way too involved in the different periodicities with the charts, etc. So let's keep it very simple. Excess demand, excess supply creates the market movement. So if the excess demand is there, buyers keep buying higher prices. Excess supply is there, sellers keep selling lower prices. And of course, it's a consistent battle, and that is what makes the market and every product that trades on any exchange a auction process. So it's an auction, just as it was when we had the open outcry pits, which have pretty much been eliminated. But you know, it's all transitioned onto the screen, and the markets are very much exactly the same thing in the fact that they're still an auction. It's now just on the screen. So that's how you want to see it. So that's the real foundational thing. So I took a bit longer on that, and make sure you get that. So now the elements of an auction: price, time, and volume. Price is the advertising mechanism, meaning that price only shows you the score. It's like the scoreboard. It's not the real game being played. It's the end result. Now, time is what is used to regulate price over time, and volume actually measures the success or the failure of each price advertisement. Now, when I say volume, I mean volume at price. This is what you get from the volume profile. Now, time at price is what you get from the TPO profile. You can use a combination of both. You can use just one or the other. Doesn't matter, same concept. So what happens is market participants from wherever they are from and however they decide to trade, whether it's systematic, mechanical, whether it's discretionary, whether it's short-term scalps, whether it's intraday swing position trades, whether it's longer-term trades for days, weeks, or months, doesn't matter. Perception. The perception creates the opinion, the belief, then that leads to the behavior. The behavior is very simple: buy or sell, or spread, buy and sell. Now we have an impact on price. Now obviously with a collective conscious, many different players in the marketplace from different countries all around the world, robots as well as human beings, doesn't matter. Same process. So this is what happens with price. It moves higher until buyers, at least short-term intraday. So if you're looking at a short-term chart, it's moving higher intraday, meaning it's trending short-term higher. That's because right now the short-term buyers are willing to do business there. You know, could be some longer time frame buyers there as well. But we typically will have this ebb and flow between short-term, long-term, which will be similar to in the pit being the institutions outside the pit trading with the locals in the pit. The locals will be the short-term market makers, providing the liquidity or providing the opportunity for the institutions to trade with them. So they become like the shorter time frame trader. Or you can also look at the institutions, the banks, hedge funds, etc. as a longer time frame trader. So let's just break it down to that, keep it very simple. So basically it could become disadvantageous intraday for the shorter time frame buyer, but it may become advantageous for the longer time frame seller. So we basically have these tugs of war based on different perceptions. Now here becomes the problem for most volume profile, market profile, auction market theory traders, as I found over 10 years ago. You have this thing called balanced markets and imbalanced markets. Very simply, a balanced market is a sideways market. A trending market is an imbalanced market. And we ebb and flow from trends to balance or trends to non-trend and sideways, or balance to imbalance, etc. And it just goes through those cycles. So there's cycles and there's a real order to the markets. Just keep that in mind. So basically, when the market is balanced or sideways, typically what creates this is the perception of the market participants, at least at that moment in time, have agreed on a range which is based upon real trades and real volume that is taking place in real time. And this is ever changing, but it continues to evolve throughout the day and throughout the days and throughout the weeks and the months, etc. So the longer term you get out there, the bigger these value areas can be. So value areas basically, very simply, where 70% of the volume traded. The higher area will be the value of high, the lower area will be the value of low. But that's basically where 70% of the volume traded. Or let's just keep it very simple and say where most of the volume traded. Now, keeping in mind the purpose of the marketplace and any product that trades on any exchange is to facilitate trade. So if there's a lot of volume trading there, the market quite likes to do business there, because we found like an equilibrium between the buyers and the sellers, and we're pretty happy doing business there until something changes. And that's when we get imbalance. Now, imbalance would occur typically if we get some acceptance above value or some acceptance below value. If we're accepting within value, of course, value is still being proven at where it is. This is where volume at price is measuring the success or the failure of those price advertisements. So if real time you see the market moving higher and the volume profile starts to build and show more and more interest there, you can start to think about the fact that this market might be willing to try to move away to a completely new value area, or it might find value where it is right now. So herein lies a problem, because what we will find when we look at the charts is that the market will be balanced, but it would need to test slightly above the previous highs, slightly below the previous lows. And if you consistently look at any chart on any time frame, you'll see these sideways ranges where we just poke through the highs, poke just through the lows. Now, I found a way to deal with this through the Fibonacci extension. So I use Fibonacci retracement extensions using a 127.2 and 161 point extension. Typically, if we don't take out the 161 point extension, we have a very good chance of rotating all the way back to the other side of value. The way we measure these extensions is very simple. For the extension upside, we measure a high to low, the last high to low, or we measure the last swing low to high. We can pick some other swings if we like. That becomes a little bit more complicated, but that's enough to get you started. So as long as, so I basically made this very simple. As long as we don't take out the 161 point extension, we still have a very good chance. We're just testing these higher prices or just testing these lower prices. And you'll see on the charts that I show you, it's very, very consistent. Now, if we do break and accept above the 161 point extension or below the 161 point extension on the lower extension or the higher extension, we will see volume at price showing us the acceptance there. Now here we typically go to the 261.8 extension. So this is where I actually really find that imbalanced trades are worthwhile taking. So majority of the time I just trade value, and we still look for opportunities to trade around value at least until that 161.8 Fibonacci retracement extension is broken on either side. So it makes it very, very simple. This is a problem that I had with profiling and auction market theory concepts. And there was no answer to this, but I found that I've been using these Fibonacci extensions before I got into profiling, and I had the answer already. So it works very effectively on any market, any time frame, as you'll see. Hence the reason why I called it the trading framework, because it does provide exactly that. So this is a daily chart of the E-mini S&P. You can already see, I've got valuers going years back. So these are daily bars. You can see this swing low to high was measured. I just need to take that a little bit lower there, that swing there. But these swing lows to highs were measured beforehand, before we took out the lows, before we took out the highs. As you can see, this is a big spike down we had. I think it was on the Brexit or something like that. And we basically come all the way back up, all the way to the other side of value, hit the 1272 extension, little response, come back up. Now we're above the 161 extension, but we've got acceptance here. You can see on the volume profile. So now I expect this E-mini S&P daily chart to move up to 2325, the 261 point extension. Okay, so that's the framework. Now, if we look at the E-mini S&P on a 60-minute chart, we've got a value here beginning, and I'll take these real time, and I'll just let it evolve and I'll let it expand. So this is building real time every day. I'm using market delta here, but you can do the same thing in Investor RT, Sierra charts, Ninja Trader. So I've got a value of low here and a value of high, and you can see this is building real time. So this is updating. So if the value of high, value of low changes based upon the volume that's being traded there, that's fine. Now, what I did with the trading framework, I took it a step further and applied some of the other concepts that I used to use prior to getting into auction market theory. So this is it in a nutshell. This is the basics of the stages that all markets go through. And again, I've been trading over 14 years and this is still consistently proven. But, you know, it's oversimplified model of the market in terms of finding value and, you know, seeing these cycles, but it's definitely there. So we have stage one, accumulation, stage two, which is when buyers do aggressively buy above a shorter term balance value area. So imagine stage one and the stage three is a shorter term balance value area. What I found, because this is very fractal and you know it's really a top down approach which you want to practice here. So if you want to start on a intraday trading approach, you want to focus on like a daily or a 60-30 minute chart and then move into your shorter term charts for intraday trades. So what you might find, for example, is like on a 60-minute chart that I'll show you in a minute on the mini S&P, we've got value that's built over days, weeks, you know, and we've actually got the stages forming, stage one and stage two and the stage three and the stage four. I'm not going to go into too much detail here because I want to keep this short and sweet, but you know, all of this is explained in a lot more detail in the courses on the website. Now, if you have a look here, I already measured the swing low to high here on the mini S&P. This is a 60-minute chart. You can see we didn't take out the 161 big extension. So for me, that means framework-wise, we got the potential to move all the way to 2268. Now, what you're finding though, and this is where people get a little bit confused, and this is discretionary trading, remember, this is about making choice decisions that you believe in. But you need to understand what you're looking at. So what I would do is put a profile around this, and this will become a stage one. So now I know this market could indeed continue to trade around the stage one there, but it also could indeed move to the stage two and get to the unfair highs here. So what I would do is use that knowledge, that understanding to pick some points here. So we're into prior values, we go to the left, but we've got some value below now. So I would go ahead and do something like this, where I'd say, okay, well, based upon what I'm using here as my framework for making choices, decisions to trade with, the trading framework concepts, you know, I can see the opportunity for the stage two, but I can also see the opportunity for the stage one. This is where people get confused. They don't know what to do, but you have to make some kind of judgment here, and you have to choose, what am I going to actually focus on? So what I do is then called vision. So I'd say, well, I won't touch it in this range because I don't really know. I'm not too sure. Now, there's no certainty, but I at least want belief and confidence. So I'd say, well, if we get above 2255, except around this area, this is a composite profile on the right, going back a few months. If we go 2256 half and above, I'm thinking, okay, well, we're now trading. Are we accepting there? Are we accepting? Yes, you'll see that intraday. If we are, got a good chance, a better chance to get to 2268. But let's say if we just get above 2255, no volume trades there, no interest, we get straight below 2255, stay away for the shorts and the longs. Now, I can sit there and say, okay, well, if we, however, get below 2250, even better 49s, I'm going to expect to trade this and expect this market to be able to go to 2241, 2240, because that's now the value of low, disadvantaged prices for the sellers, where the buyers will probably be waiting. So I would now see an opportunity for a short below 49.5, but a long above 2255. So I would go ahead and then pick these points. So well, I'm going to watch this intraday for longs. I'm going to watch this area for shorts intraday, because that's the stage one. But I know we've got a wider value where we can go to stage two. So this is how you deal with it. And we just leave this area in the middle alone, where it can really go either way. I mean, it can still go either way, but we want probability on our side. And most importantly, you want belief and confidence. Now, again, you know, this goes on short term as well. You've got a mini Dow chart here. You can see these short term balance value ranges. And now if you're more of a scalper, you might look at this kind of stuff. But again, you know, I'd put these profiles in as soon as we get like a 80 to 120% retracement. So that'd be like low to high, 120%, no more, back down, 100%, 80%. See that? So that's, once you get that first swing up or down, which potentially is the first sign of balance value, that's when you put your profile in. Then you just let it build real time. But, you know, again, I'm showing you stuff in hindsight here, but you'll see how this applies real time. So before these highs get taken out, I can have this swing high to low to measure. Look where it hits 161 point extension. Before this breaks this low, I'll have this low to high measured. Where does it hit? 1272 extension all the way back up. And again, you just go on and on, any market, any time frame, you see the same thing. That's the trading framework in a nutshell in less than 15 minutes.